is 19 minutes to close one of these deals from scratch, right? Where's Mona? Mona did one, I think, in 5 days. So this is really, really possible. Anyone can do it. But let me tell you a story. So I said to the seller, I said, hey, you must have an absolutely best-in-class business because you're asking for a multiple that is way, way beyond the other 50 deals I've looked at this month. He's like, what are you talking about? We bought a bowling alley. Chris came up to me one day. He said, I found a seller with the highest MUD score in history. I'm like, dude, take me. Is my money safer in the stock market or is my money safer inside of my own company? What is an annuity deal? Well, let me tell you a story. This is about 2.5 years ago, and I'm doing seller calls. So I was doing off-market deal origination, and I found a company. It was a web design firm. And I had a call with the seller. It was late at night, and we were going through the business. He sent me some numbers. And as you saw from this morning, what's like an average multiple for an average business? 3 times, right? So marketing agencies or web design companies, generally, they're worth about a 3 times multiple, right? You get that. Glad you were listening. Now, this seller, his price was a 6 times multiple, and there was no transfer of value. It was an average business. So I said to the seller, I said, hey, you must have an absolutely best-in-class business because you're asking for a multiple that is way, way beyond the other 50 deals I've looked at this month. He's like, what are you talking about? Multiples? Like, I've got no idea what you're talking about. My valuation was determined by my wealth manager. I'm like, really? Wealth managers are not trained to value businesses. But tell me about that. He said, well, I called my wealth manager and I said, look, there's this Carl Allen guy. He wants to buy my business. He's just written me a letter. And I've got a call with him. I got to tell him how much I want for the business, right? So the wealth manager said, well, okay, you're going to do the deal. He's going to pay you this big closing payment. And then you're going to pay like 45% tax on all that money. And then you're going to invest that money into a money market account. And you're going to pay tax, you're going to pay fees. And then it's going to pay you so much money per month. So how much money do you need per month to retire and not have to materially change the standard of your life? So it came up with this number. I think it was $8,000 or $9,000 a month. So the wealth manager did the math and back calculated all with all the taxes and all the fees and all that stuff, and it came out to become a 6 times multiple. And I said, that's crazy, right? Your business is not worth a 6 times multiple, right? I said, but why don't I just become your annuity provider? You're looking for an annuity. You're looking for between $8,000 and $9,000 a month for 10 years. That's why you've got this crazy valuation for your business. But why don't I become your annuity provider? And I'll just pay you from the cash flow of the business. And he said, you would do that? And I would save all that tax? I said, yeah. And then he paused and he said, I've just got one question though. He said, what I'm trying to figure out in my head is my money safer in the stock market or is my money safer inside of my own company? And he answered his own question. So we did that deal. And then I started teaching how I'd done it, and then all my proteges started doing those deals. So that's where this came from, right? So I'm going to talk about what an annuity deal is. And it's like buying a business. It's like a lease to own. It's like leasing a car. It's like, buying to own a car, buying to own a cell phone, buying to own a laptop. And a lot of things that we buy in life, we can finance them, right? And we can finance them generally by paying the seller of the product or service over time. So this is exactly what we're talking about. So I'm going to walk you through the annuity deal structure. I'm going to walk you through why they work so well. And I'm going to delve into ethical mind control techniques, right? Ever seen Star Wars? These aren't the droids you're looking for. These are ethical mind control techniques, but it's all about selling the benefits of this deal structure to the seller. All an annuity deal is a 10-year seller financing note. Nothing new with that. But what's cool is how you sell those benefits. And there's a very interesting psychological tactic that I use to get sellers to do these deals. So an annuity deal, really, an annuity comes from like the financial markets. You know, you can dump a load of money into a product and then it pays you like a bond, and then it pays you a fixed amount of money over time. We're just saving the seller from taking the big closing payment, paying the tax, paying the fees, investing what's left into a product and getting that annuity stream. We're just becoming that annuity stream provider. And it's just like leasing a car, right? So if you want a Tesla, you can rock up and you can buy a Tesla for cash, or you can finance it. And Tesla will, in some cases, finance that deal for you. It's exactly the same thing. So the basic annuity deal structure is very similar to like what I talked about this morning, that primarily it's like a sub-2 real estate deal. You're inheriting whatever liabilities are inside of the business. The vast majority of what's left is basically seller financing. You can have earn-outs in there as well if you want to. The only cash that's going to the seller at closing is the surplus cash that might be in the business. So you're not going near any banks, you're not going near the SBA, you're not going near an investor for AR or equipment or anything like that. So because you're not going near any external financing or any investors, these deals are very, very fast. And this is why they work so well, because only 1 in 11 businesses that try to sell actually do within the first 12 months. And remember, I talked to you this morning about liquidation value. So if you own a business, if you're the 10 out of 11 that can't sell their business, what are you going to get is liquidation value. So if I rock up and say, hey, I'll pay you 5 times your liquidation value, but you get money over 10 years, that's better for the seller than shutting the business down and basically erasing the last 10, 20, 30, 40 years of their life. But the power is in the benefits, right? The power is in the benefits. The number one benefit of an annuity deal is it's quick, right? You can do an annuity deal in a day, but allow yourself 2 weeks if it's your first deal, right? And they're very, very light touch due diligence. So due diligence is the process of vetting the company, right? If the SBA is putting 80% of the money in, they will DD that business to within an inch of its life, which is great because they do all that work for you, right? They make sure they do a quality earnings report. They check every single thing in that business to make sure it's like phenomenally good. It's like a home inspection report. You know, if you buy a piece of real estate, if you're not putting any money down on that deal whatsoever, you probably will do a very, very light touch home inspection report. If you're putting all your money down on that, you're going to protect yourself and probably pay for the most expensive report that you can get. So when I do an annuity deal, I do extremely light touch due diligence. I do the majority of the due diligence actually after I bought the business, right? So all I do is I make sure they've paid their tax returns, and I have my attorney just verify that it's legally safe for me to buy the business. All the other DD that you would do, I do it after I've bought the business. And if the business doesn't stack up, if it's not what I thought it was, I can just give it back and walk away, right? So one of the other massive benefits of an annuity deal is it's solving a massive retirement problem in this country. Who can remember what the average retirement pot size is for a retiring baby boomer in this country? $202,000, right? So if you're an average baby boomer retiring and you've got 10 or 20 years left to live your life and you've got $202,000, you're going to have a drastic change in your lifestyle. Retiring baby boomers, their retirement pot, the bulk of it is the value that's locked into their business. So by structuring a deal like this, you're allowing a boomer to retire without drastically changing their lifestyle. In some cases, their lifestyle improves. The two other major benefits of these deals, and I touched on one of them this morning, was if you're buying a business and the seller's taking all the risk, and you're paying for that business over 10 years, then you're going to be paying a lot more to buy the company, right? I showed you the example this morning. So not only is it a super quick deal for the seller, they're getting more money over a longer period of time. And it's also very, very tax efficient. I'll show you the changes in the IRS tax codes which allow this to be the case. So I won't bore you with the UK changes. I don't think there's anyone here from the UK apart from me. Where are they? But in the US in 2022, the IRS changed the tax code. It was called IRS P537. And that change to the tax code allowed sellers to take seller financing deals and only pay the tax when they actually receive the money. Normally, before that, if you did a seller financing deal and it was $1 million deal over 10 years, the IRS would tax them on the $4 million in the year of sale. So that killed this, right? But now you can do it because they're only going to get taxed when they actually get the money from you. So they don't have the retirement savings that we think they have because the value's in their business. And they're just really nervous about trying to stretch that massively taxed money from a closing payment over the rest of their life. And one of the things that's really cool, and 4 or 5 sellers have said this to me when I've done annuity deals, but they said, you know what I really love about this deal, Carl? It's like, I'm still getting paid from my business, but I don't have to go and work anymore. A lot of retirees want income. They don't want that big capital gain. They want the income. They like the security and the regularity of regular monthly income over an extended period of time. And what's also really cool about an annuity deal is for a lot of retiring baby boomers who are legacy driven, they care about their employees, they care about their customers and suppliers, they almost stay connected to the business, right? Because they care about it. They're connected because they're getting money out of the deal over a long period of time. And the selling motivators are clear. We talked about this yesterday, that 80% of people that sell, baby boomers especially, they sell for non-financial reasons. So if you're positioning yourself as that safe pair of hands, you've got no like and trust like Abraham and Pace was talking about. You've got credibility. They've almost fallen in love with you. You've got a friendship with them, right? That's going to drive higher success in doing annuity deals. And remember this morning I talked about seller psychology, right? Seller psychology is like, it's everything. When I was a Wall Street guy, 10% of a deal was psychology. 90% of it was just math. It's just financial engineering. But when I went from Wall Street to Main Street, 2008, one of the things that I couldn't get my head around initially was how much Main Street deals were not about numbers. They were about that seller psychology. Remember, you're buying and selling a business between human beings. You build rapport, you build no like and trust, you position yourself as a safe pair of hands. Those are the things that drive these types of deal structures. And remember the 2 sellers that we talked about on day 1 and also this morning. Like, annuity deals are perfect for the guy on the right, the retiring baby boomer, distressed, wants a super quick deal, doesn't want to wait 16 weeks to get the money from the SBA, would rather do a quicker deal that's a lot less stressful versus the guy on the left. If you find the guy on the left still do that deal, you could do an SBA deal. We talked about that this morning. And Zafrina was the first person in Protégé, my program, that closed an annuity deal. Like, literally within 2 weeks of me announcing the training, I said, guys, I've just done this deal, right? It's a 10-year seller note, but it's how I positioned it, how I got the seller to agree. I want to talk to you about it. And then everybody started doing deals. So Zafrina did one. Jim's done like an absolute boatload. Jim Helms, he's one of like my most successful students. Brittany's got the record for the largest annuity deal, $7 million value deal over 10 years, annuity deal. Nikolaya down in Florida, he did an annuity deal. This is probably my favorite one. He did an annuity deal not only on the business, but the seller liked him so much, he even did an annuity deal, a seller financing deal on the real estate, which is crazy because anyone can finance real estate, but the seller said, no, I love the fact that we can do this deal tomorrow. You don't have to go to the bank, we don't have to get appraised. Let's just do it all on a 10-year deal. Even Chris and I, we bought a bowling alley. Chris came up to me one day and said, hey, Carl, like, you talk about this MUD score when you're coaching protégés and you're reviewing all of their deals on the red light, green light call. He said, I found a seller with the highest MUD score in history. I'm like, dude, take me. So we went down to Alabama, couldn't understand what the guy was saying. As you know, hey boy, you're not from around here. so I'm sorry, I've got no clue what you're talking about. But Chris was translating, and it's quite a sad story. The seller, both his wife and his, was it his daughter, Chris, had got critical terminal illnesses, right? And he had a 9-to-5 job working construction, and he had this bowling alley which is only open on evenings and weekends. So like he couldn't care less about this bowling alley, but he wanted somebody to take it on, and Chris bowled there. He's a bowler. So we ended up doing this deal. And the really cool thing about it, you'll see the little room on the left. About a week before, I'd been in Jacksonville with some partners with Chris, and they took me to Dave & Buster's for the first time. I'm like, I'm just a kid, I'm a gamer. So like, I couldn't believe it. There was an arcade the side of fucking Walmart where you could go in and play all these games, right? So I said to Chris, like, you know these party rooms that we've got? Can we create our own little Dave & Buster's? He's like, yeah. So we had it all renoed, and then all these machines, you don't have to buy them, right? You don't have to even finance them. You call the company and you say, hey, put all these games and machines and things in my room. You pay for it all, you maintain it all, and then we'll 50-50 rev share on all the income. How much cash flow, Chris, does that little room generate? About $5,000 a month. It's insane. No money down deal. So again, let's talk about the benefits, because these are what are really important. These are very, very quick deals to close. You can literally do these deals same day, but take 2 weeks for your first deal just to do it properly, versus an SBA deal that might take 16 weeks or longer because of the financing protocols and the process that they go through. Now, security. So if you go to a bank and you borrow money to buy a business, they're going to put a lien over that company, right? Of course they are. So if you don't pay, they just take the business and sell it. Same with a house. So what we do is we give the seller the same lien over the business, right? So if you don't make the seller financing payments, they're going to get the business back. The other thing that we do is we give them a performance guarantee. So whenever you go and use bank financing to buy a business, what the bank will do is they'll make you sign up to something called a covenant. And what a covenant is a set of financial rules that the business has to adhere to. Otherwise, the bank has the right to call the loan. It's to stop you raping and pillaging the business, running away with all the cash, and letting the bank have to take it back. So we give that same guarantee, that same covenant to the seller. So the seller gets monthly financials, they can attend the meetings, and they have a 100% lien over the business. If you don't pay, they could just come and take it back from you. And what's really interesting about this is when you're negotiating a deal, right, there's only 2 variables in every acquisition, right? There's 2 variables in an acquisition. There's price and there's terms, right? So the deals that close are when the buyer or the seller chooses one of those terms, right? So if you're a buyer, you can't control price and terms. If you're a seller, you can't control price and terms. You've got to pick one. Otherwise, the deal's not going to close, right? So an annuity deal is the seller dictating the price, but then I'm dictating the terms, right? In an SBA deal, the seller's dictating the terms. I want 90% of my money at closing. Great. I'll let you control the terms, but now I'm going to control the price. You can't control both. And deals that close are where one side picks the other, right? Really, really important. So an annuity deal is you're dictating the terms of the deal, i.e. I'm going to pay you over 10 years. The seller is confirming the price. And what's also really cool is, and Jeremy and I have got a deal at the moment in the online coaching space that we're doing, where the seller, lovely lady, built an incredible business, and she just can't handle the due diligence. We've agreed it's a $3 million acquisition. It's doing about $1.5 million in EBITDA, so pretty low multiple. And it's $1.5 million at close and $1.5 million in seller financing. But for me to cut $1.5 million check to buy that business, those numbers have got to be like spot on. We're doing quality of earnings reports. This business is like all over the place, right? So we've said, I'm not going to pay you $1.5 million at close because I can't verify your numbers, right? So this has got to be an annuity deal because she can't go through the stress and the brain damage of having to pull all of that data, she's done. Like, she's really, really sick, right? But still, I'm sympathetic to that. But I'm not going to risk $1.5 million of our money to do this deal. So it's going to have to be an annuity type deal structure. And a lot of these business owners, they don't want to wait 6 months. If you're doing off-market deals, which is where this works the absolute best, if you're doing off-market deals, you're catching those sellers on that particular day, whether you're writing to them, it's a call from somebody in your network, or you're leveraging social media, right? So you're hitting them, and then when they meet you for the first time, they'll psychologically have sold their business, right? They're gone. And then they don't want to wait 4 months, 5 months, 6 months for you to go down a complicated financing route. They want that deal to be done super, super quickly. And they don't want to have to go through the pressure and stress of having to pull all the documents and paying the CPA to do all the work and doing all that stuff. So it's a really kind of cool strategy to get them out of the deal super, super quickly, so they don't need to worry about all those different things, right? So let's have a look at a deal. Now, this doesn't really work that well with brokers, because the problem with brokers is, fucking hate brokers, but the problem with brokers want paying at closing, right? Brokers are in the business of selling businesses. They charge the seller a commission on the deal. So if you're doing $1 million annuity deal, and the broker's on a 10% commission, that broker wants $100,000 at the closing table, right? The seller doesn't mind. The seller's going to get paid over time. The broker's not going to wait 10 years for their money. So brokers can often kind of scupper annuity deals. So they work brilliantly when you do off-market deals, right? But just to show you a real example, I was on Biz Buy Sell. If you've not seen Biz Buy Sell, you click the state, you click the industry, and it pulls up all the listings. Quick little new mental math tip for you. When you're going through these deals, the number on the top is the asking price, the number below is the cash flow. And then you're just dividing one by the other, and get used to doing that mental math. Anything less than a 3, have a look at those deals. So the deal in the middle, interesting deal. They want $1.5 million for it, and it's cash flowing $700,000. So that's a 2.1 times multiple. So that's pretty low. But you know what I love about this deal the most? It's been established 40 years. How many businesses fail in the first 10 years? 96%, correct. Do you know how many businesses fail in the first 40 years? It's 99.99%. Like 1 in 25 to 30,000 businesses will survive 40 years. That's crazy. So this is a cool business, right? It's been around for 40 years, must be doing something well. Let's have a look at this deal. What's the huge big clue in the top left of this screen? What does it say? Why do they do that? Are they dumb? Seller financing available. Wow, okay. How much seller financing available? That's the big question. But, so I'm really interested in this deal. I'm looking at it. It's doing, I said about $5 million in revenues, $700,000 in EBITDA. Absolutely fantastic. 40 years. It's an LA company. It manufactures commercial and residential, like high-end cabinet furniture, and it's growing, right? It's growing. It's going to grow to 5.4 million this year. So it's not a stagnant business. It's continuing to grow. Now, remember this morning I talked about the valuation range, that if 100% is the maximum you're going to pay for a business on an annuity, you're generally going to pay about 57% if you're buying the money with the majority of closing. So what we do is we do something called the 2-offer strategy. So we make an offer to the seller. We put 2 offers side by side. We make the lowball SBA offer with all the cash at close, like horrible. And then we make the annuity offer, which is super, super quick. They're going to get a lot more money. They're going to pay a lot less tax. They're not going to get brain damage from the bank due diligence. We make that super, super attractive. So 2-offer structure, you guys will be pros at this now because we went through it this morning. So the business is doing 5.4 million in revenue, $700,000 in EBITDA. It's a $1.5 million ask. It's a 2.1 times multiple, right? So let's assume that $1.5 million ask, because we know they'll take seller financing. It was on the website, right? So that deal is going to go right in the middle of the valuation range. And I know from my algorithm and my model that I give my proteges that if it's going to be an SBA deal, and the seller's going to get 90% of the cash at close, it's going to be a $1.1 million transaction. versus if it's a full 10-year annuity deal, it's going to be a $1.8 million transaction, right? So now I've set the boundaries of what my two offers are going to be. So offer one is going to be 1.1 and offer two is going to be 1.8. And when you make two offers side by side, it's that ethical mind control technique, okay? So Laura, if I said to you, would you like a glass of wine? You're going to say yes or no. So when you make a seller one offer, they're going to say yes or no. If I said to Laura, do you want red wine or white wine? Her brain, her 2-million-year-old brain, is going to pick one or the other. The brain is programmed to make binary yes-no decisions. So if you give a seller two offers and you make one super attractive and the other one dog shit, they're going to go for that super attractive offer. They can't help it. It's the way their brain is designed to work. So let's do a two-offer structure. So we went through an SBA example this morning, so I'll whiz through this really quickly. So let's say it's a $1.1 million deal. Again, it's a 10-80-10 deal structure, 10% buyer's cash or an investing partner, 80% SBA loan, 10% seller note. That's going to cost you about $134,000 a year at 9%. Massive cover ratio. This morning, the example was, I think, 3.1. This is a massive cover ratio, 5.2. So you're making 5 times more cash flow in that business than what you actually have to pay out to do this deal. So if you did that deal with the SBA and you put the $110,000 in, you're going to get your money back inside of about 2 months, right? Because you're going to free cash flow about $566,000. Well, I actually wouldn't do that. I'd go and get an investing partner, let them come in on the deal with you as an investor. They'll take, say, 25%, you'll take 75%. You're still going to cash flow $424,000, but you've not had to put any money into that deal. So that's offer one. It's a great deal for you, but we're going to make it a bad deal for the seller. Offer two is a 10-year annuity deal. $1.8 million valuation, which is more than the asking price. It's going to be $180,000 a year times 10, right? That's a cover ratio of 3.9. So it's still really, really high. One of the reasons why this is a deal that works so well for annuity is because the valuation multiple is so low, that tells you the seller's got a very, very high MUD score. Otherwise, why would they be pricing the business? This is like the deal of the century. This is a crazy low multiple for this type of deal. But then you could create other offers. You could say, well, actually, what about a 5-year annuity? So again, if you come down the valuation chart, let's say that's a $1.6 million deal, not a 1.8. Over 5 years, that's a $320,000 a year annual payment. That's a debt service cover ratio of 2.2. So you're going to cash flow $380,000 a year with that deal, $520,000 a year, you do the 10-year annuity, and $566,000 a year if you do the SBA. So that's pretty life-changing cash flow, right? And as I've said, you can do that deal tomorrow. Like, you don't have to go down the SBA route. SBA deals work brilliantly in a lot of cases. But if you've got a seller with a really high MUD score that wants to come out of the deal and you build unbelievable rapport, know, like, and trust, and you position yourself as that safe, trusted pair of hands, you can do these deals. Seriously. I've had over 50 proteges do an annuity deal in the last 6 months. Absolutely unbelievable, right? So let's say the seller agrees to the 5-year annuity. It's a $1.6 million deal. And let's say there's $100,000 of surplus cash in that business. You pay that at close, and then you just cash flow the $1.5 million over that 10-year period. So it'd be $150,000 a year, right? So now let's see what would happen if you did that deal, right? So you could do that deal tomorrow. Well, no, it's Sunday. I think you could do it next week, right? So you do that deal, then let's see what would happen if you grew that business. So now it's doing 5.4 mil, $700,000 of EBITDA. We're buying it for $1.6 million, which is a 2.29x multiple, and we've got 12.9% margins, which are about average for a timber manufacturing company. You grow that business over 3 years. Let's say you only grow it at the current 9% growth rate. If me and Chris Moore were your partners, we'd probably double that business every year. But let's just have slow growth, 9%. So if you compound the growth from 2023, 24, 25, 26, you've now got a business doing $7 million of revenues. You're going to be able to increase your profit margin because as you grow a business, your fixed cost base stays the same. So your profits go up higher than your revenues. So we could probably get at least a 15% margin in that business if we grew it. So now it's doing $1.05 million in EBITDA. We're probably, if we sold that business, going to be able to get at least a 4x multiple for it. So you've like almost tripled the valuation of that business through doing this deal. So you've now got a business worth $4.2 million enterprise value. If you sell it in 2026, you're probably going to still owe $500,000 to the seller in terms of the annuity. So I taught you this morning that equity value was the enterprise value less the debt. So you just made $3.7 million in 3 years doing that one deal, right? But not only that, as the owner of that business, between 23 and 26, you're cash flowing on average $875,000, less than $300,000 a year to pay for the annuity. So you're pocketing an average of $575,000 a year over 3 years. That's an extra $1.7 million. So you can do that deal. The cash flow as the owner, less the annuity, and the cash flow from the exit, you just made nearly $5.5 million on one deal. And you could go and put an owner manager in there, an operator, run that business for you. You could do 100 of these deals, like seriously. And then at an exit, the seller might still want to have those annuity payments, but the buyer can assume that, right? The buyer can subdue that annuity stream, or the seller might say, well, actually, I've enjoyed the first few years of payments, but yeah, it'd be nice to get the rest, although they'll pay the tax. You can negotiate an early settlement on that to pay it out early. So that might give you an extra $100,000 or $200,000. Now, in some cases, not all of the benefits of an annuity deal are going to resonate with the seller, right? Speed to closing. Name me a seller that doesn't want a laser-fast deal, right? Every seller wants to close the deal as quickly as possible. And all sellers hate dealing with due diligence requests. They hate it. They want to be out of the deal. And they don't want to get brain damage, right? But they might not care about the tax efficiency. They don't want the money over time. They want the money soon. And they don't need that retirement fund booster, right? So what we can do in that instance is a hybrid deal or a refi. So a hybrid deal would be, you'd start the deal off as an annuity. Remember, it was a 5-year annuity, $1.6 million valuation, $320,000 a year annual payment. But then you're contracted to refi that deal in, say, 120 days. Now, what's brilliant about that is you're dealing with the process. You're dealing with the due diligence from the bank. The seller's sold the business to you. You're now the owner. You're dealing with all of that stuff, right? So that's a massive benefit to the seller. Then you could refi them in 120 days. I've just literally done a deal like this, and I'm close to, I got a term sheet for the refi, and the seller said, nah, I'm loving these like $11,000 a month payments. It's like freaking amazing. Like, you know, you're a really good guy. The employees love you. The numbers you're sending me are like off the charts. Like, keep going. Like, I don't want this like refi. So even though you could put a refi in the contract, it's like a wrap deal, right? It's like a wrap sub too. Like you don't necessarily have to go through with that. The seller might change their mind. And it's good for you if that happens, because you're going from cash flowing 380 to cash flowing 566 if you did the SBA refi. Because again, you're going back to that lower valuation, right? Wholesaling. This is going to blow your mind, right? Who wholesales real estate? Okay, so is it fair to say by wholesaling a piece of real estate, all the sub-2s that I've done, real estate deals, I've paid between $10,000 and $15,000 like as a wholesale fee. Is that about right? Okay. What if I told you you could wholesale just that one business I've just showed you? What if I told you you could earn $1 million in cash from wholesaling just one deal? Would that blow your mind? Right, so I need some volunteers. So I'm going to have Laura Reeves. Come on stage. I need some volunteers. I'm going to have Heather. I'm going to have Crystal. And I'm going to have Alan Sow. Come onto the stage. Right? So if you stand towards there, right? So you're the business, right? So pretend you're a company. So you're a business and you're cash flowing $700,000 a year, right? Now, Heather, you're the seller, right? So just hold that up for me. I'll go through that in a minute. Crystal, you're the buyer. That's your number. And Alan, you're the wholesaler, right? So just hold those up for 1 second. So let's say we did that 10-year annuity deal, right? So that deal is cash flowing $700,000 a year in EBITDA, right? So that's Laura. Laura's the business. She's generating $700,000 a year in EBITDA, okay? Now, the terms of the deal where the seller is getting $180,000 a year, right? So Heather, you're getting $180,000 a year on a 10-year annuity, but Laura's the business, which is Laura, is cash flowing 700, right? Now, let's say Alan is the wholesaler. He finds that deal, he locks that deal up under contract, right? Alan can say to Crystal, look, I found this deal. How would you like $416,000 a year of completely free cash flow? Do that deal today. What are you going to say?
Yes, please.
Yes, please, right? So Crystal's not getting the 520, which is the difference between what the business is cash flowing and what we've contracted to pay Heather, the seller, right? So Alan could actually say, well, I want half of the cash flow for wholesaling it. And Heather might say, well, yeah, I'd be happy to do this deal and only get $260,000. But 20% of the total cash flow is generally what I think would work. So Alan's coming in and saying, look, I found you this deal. I don't want anything to do with it. I don't want to run it. I'm completely hands off, but I'm going to contract to you. I want that cash flow of $104,000 per year over the 10-year life of the annuity, right? So Alan's making $104,000 a year. Crystal's doing really, really well. She's making $416,000 a year. She's not had to find the deal. She's not had to negotiate the deal. It's effectively like a deal she's inherited, but she's got to go in and she's actually got to operate it or find somebody to run it for her. Heather's happy because she's retiring. She's got no stress from due diligence. She's done the deal super, super quickly. She's paying a lot less tax and she's getting a lot more money for her business over a longer period of time. And it's almost like she's being paid $15,000 a month from the business that she doesn't have to work in anymore. And then look, that's the cash flow. 700 equals the 180 for Heather, the 416 for Crystal, and the $104,000 for Alan. Now, if Alan is in that deal for 10 years, he's going to make $1,040,000 from one deal over a 10-year annuity. Is that amazing? Is that better than wholesaling real estate? So, who wants to learn how to do this, right? I want you to do this 30 days, right? You can do this in a day, but I'm going to give you 30 days to implement the strategy. So here's how you do it. Number one, this is recapping some of the stuff we've already talked about. Number one, dial in your mindset, dial in your why, right? Believe in yourself, be intentional, originate deals, meet sellers, make offers all the time. Define your buy box, right? Define your buy box. What deals can you get into that serve you and you can add value? And then don't go to your brokers, right? Go and originate 25 off-market deals that Abraham showed you how to do this morning. Really, really important. This is a lot easier to do with off-market deals. If you do find a broker deal and there's a lot of surplus cash on the balance sheet, which will pay the broker fee, the broker should love this deal because they're getting a lot more money over time and they're cashing out their fee, which could be up to double at the closing table. But off-market deals are really where you should do this. And then make an annuity offer on every single business, right? Just make annuity offers. Don't think about closing payments. Annuity offer, every single one. Because if you do that on 25 deals, more than one's going to say, yeah, you might only need 5 deals or 10 deals or 15, but just to stack the deck in your favor, just go and find 25 off-market deals, meet 25 sellers, and do an annuity deal offer on every single one of those businesses. At least one of those is going to say, yes, I want to do that, right? So then once they say yes, you sign an LOI. Then you can do very, very, very basic due diligence. Just have your attorney make sure it's safe to buy and just make sure that they've filed their tax returns, close the deal, and then you can do the detailed due diligence after you've bought the business, right? And if you go in there, you get the CPA in, you get the financial controller, you go through all the numbers, and you say, you know, tell me what I really need to know. And you think, well, you know what? I hate this business now. I don't want it. Just give it back, right? You've lost 2 weeks of your time. And then once you've done one of those deals, at least one more, or maybe 2 or 3 more, they're going to say, well, what about me? Like, why won't you do this on my deal? Well, then you can. You can do bolt-on acquisitions, and you can do a roll-up. Tell you a quick story. Darren Jacobs, one of my first ever proteges in the UK, his daughter she worked in a hair salon. She was a hairstylist. She came home one day from work, and she was really frustrated and upset. Her boss had been a bully, and she said, Dad, I want my own hair salon. So he went on Google, how to buy a business with no money, found yours truly, came into the program, and he did, this is before annuity deals were a thing, right? So he just did all of the deal origination, sent out a bunch of letters, hair salons within 20 miles of where his daughter lived, which was Southampton, England on the south coast. And he sent out about 600 letters, a lot of hair salons in the UK, 600 letters, and I think 92 of those sellers came back and said, yeah, we'd love to have a conversation. First seller he talked to said, look, just if you'll take over the liability for the retail store, just pay me over time. Like, I don't need money at closing. This was a seller telling Darren to do an annuity deal. So we did that deal. His daughter went in, took over that business, and then he called me one day. He's like, what am I going to do with like all these other leads? I'm like, you fucking crazy? Buy them all. Do a roll-up. So he's actually closed 36 of those deals. And he's built, check him out, Toka Group. He's built a massive group of all of these hair salons. And he's building this phenomenal roll-up, cash flowing multiple 7 figures a year. Just from doing that one deal. And then you could just roll and roll and roll. And then every time you can just do more deal origination and just bolt them all in. So that's how to do an annuity deal, 30-day challenge. Keep me posted.